Good afternoon, everyone, and welcome to the second series of the Lunch with GoalsGetter webinar. So today we've had a slight change of schedule from what the invite may have said. Jonathan from Milford got called away on a trip last minute. So today we have joining us Greg from Salt and Alan from Nikko to talk about their respective diversified growth funds. So thanks for sticking with us for another month of GoalsGetter. It's been busy here in the world of Nikko. We've had a lot of inquiry from advisors around GoalsGetter and continue to see great onboarding flow from advisors. So thanks for your continued support. Now I'm going to quickly introduce Greg, and then in the interest of time, pass over to him so we can hear about the SALT Sustainable Growth Fund. So Greg Fleming is the portfolio manager for the SALT Sustainable Income Fund and the SALT Sustainable Growth Fund at SALT Funds Management. He has over 20 years of experience in investment management, having started out as an economic analyst at Westpac Investment Management before spending a decade in Switzerland. Upon returning to New Zealand in 2015, he held senior roles at Jarden and at AMP Capital before joining SALT in 2021. So I'm looking forward to hearing from Greg today about what he's seeing going on in the market, and also about the SALT Sustainable Growth Fund, which is available on GoalsGetter as a KiwiSaver fund. So on that note, Greg, I will pass over to you to share your slides and take it away from there.
Great. Thank you very much, George. Does that look okay for everyone?
That looks good. Thank you, Greg.
Okay, brilliant. Hello, everyone. It's certainly an interesting day on which to be talking about growth funds. We're in the middle of something of a market upset, but it's been relatively recent that upset has developed because, in the immediate time after the Trump election and even the inauguration, markets were still erring on the positive side. So let's, before we look at the future, we'll say that the future is basically the consequence of past decisions. And when we built a diversified growth fund, we decided there were some structural themes in play that we had to bear in mind. And these are actually coming into play quite evidently this year, 25. First one, we're talking about lower global growth. There's definitely downward revisions there across the board, Europe as well as the US. Although Europe may actually gain from some of the fiscal stimulus just announced in Germany. So there's a cyclical slowing in world growth 25, 26. That's no surprise to anyone, but it's starting to appear that it may risk a structural element too. And that's because of the sheer disruptiveness of this new tariff agenda and the uncertainty in terms of capex planning, in terms of import and export management, all those pricing of disruption risks that you're starting to see come into markets in late February, early March, that had been pretty much discounted in December and the early bit of January. Inflation, we've got US CPI tomorrow for February. Across the board, inflation has come down, but it's stabilized at higher levels than you'd seen over much of the last decade. Parts of the inflation complex, particularly housing and accommodation related, have not come down as much as would have been ideal. There's plenty of reasons for that because much of the capacity in the housing market globally is still a bit distorted. People on very low mortgage rates from years ago, holding on to those and not selling. Current high interest rates are dissuading people from purchasing, particularly in the US. Then another factor that we've got is the interest rate level overall from central banks is at an equilibrium higher than you've seen in past downturns. So that's a wee bit problematic because it means that the central banks can't move quite as quickly in offsetting impending weakness in an economy because of those inflation pressures. Then again, there are some very real and very hard choices in fiscal world. You cannot have both tax cuts and expanded spending on whether it be welfare or on capacity building in an economy. Those tax cuts that are baked in in the US, for example, the extension for the Trump 2017 set of tax cuts are now being debated constantly. There's a potential shutdown looming after this weekend in the US, but all governments around the world have this issue. People want more and more from their tax dollar, and yet debt has been going up, and the servicing cost of that debt also rising. So a lot of hard choices. Politically, everyone knows what's going on. The world is ever more tense and fragmented, raising kind of left tail shock risks, and you have to make sure they're priced into markets. And the last point is currency volatility. You can see that with some of the safe haven currencies, Swiss franc, until recently Japanese yen moving up. US dollar had been seen also as a safe haven. So the weakness in the Kiwi has to be seen in the context of people getting nervous. But what if there is an accord to weaken the US dollar? There's a lot of speculation about a Mar-a-Lago accord. No one's actually confirmed that yet. But, if markets get a sense that these big structural shifts are being tweaked or are being lent on by policy authorities, then they can get very nervous and unsettled quite quickly. So moving on then, we've got our growth fund built around some forces that are longer term forces. We think that the world economy is going to have this lower trend growth, which impacts earnings growth, and corporate earnings are a big part of the future expected returns of any growth investment product. Then also shorter cycles, shorter economic cycles, but also shorter market cycles. That relapsing core inflation is an issue, and there is periodic downward pressure on the real returns as inflation ticks up from time to time. The next one is quite a technical sounding thing. Temporal returns compression. All it means is that good periods of gain are increasingly clustered into shorter time periods. So whereas in historical modeling, you would see the accrual of equity gains on the escalator, occasionally interrupted by the elevator, where you might get a correction or even a bear market, and then another escalator rise. We're now seeing much more patchy and short bouts of strong returns. And the post-election in the US scenario last year is merely the latest example of this. So it makes you need to be more agile. Then interest rates more stable, but at a higher level. Diminishing credit availability, both with rates higher and lenders being a little bit more cautious about who they're going to lend to. They're trying to improve balance sheets gradually, but it does undermine leveraged growth investment, which has been a selling point for some of the more punchy growth products in global markets. And there's regulatory scrutiny ever rising of the more opaque growth style strategies. Then I mentioned also central banks won't always rush straight in the moment there's a weakness via flooding the market with liquidity. The effect of that on inflation post-COVID has now been lesson learned from a central bank point of view. You can't just solve everything with opening the floodgates on liquidity because years of repair work is needed after that. When you've disrupted supply chains, you've got knock-on effects as consumers and workers try and preserve their purchasing power. So it's not going to be the easy open answer put that someone in the market had expected at the first sign of trouble. Fiscal challenges we already mentioned, and there's a demand for gradual asset price appreciation growing as people approach retirement. But yet, growth funds typically reinvest the dividends they receive to bump up the likelihood that they're on the path to their total return objectives. So how you draw income off a growth fund for investors is a work in progress for many funds managers. Going on to Trump then, I mean, he's the theme of the day. I think he's tightened financial conditions across all of his various initiatives. To coin a phrase, it's an initiative set across tariffs, immigration, fiscal policy, regulation. Overall, probably growth neutral to slightly growth negative for the US, but hitting different parts of the inflation and interest rate or price of money nexus differently. And I think that increasing risk of inflation while interest rates remain somewhat elevated, not as elevated as they had been a year ago, but still in the 4 to 4.5% range on longer bonds, is potentially a growth depressing thing. The latest bout of weakness being, of course, triggered by Trump's remarks on Sunday that U.S. economy was in a transition period rather than saying a recessionary period, but people are reading that as lining up to the administration being comfortable with a downturn in demand and activity as they push ahead with their vision for what makes an economy great. This has obviously hit sentiment very hard. And I put the little mega cap up there as a bit of a joke. That was the peak of animal spirits bullishness that came in at December, basically. And all positive aspects of a potential Republican sweep were priced in rapidly. Tax cuts, freedom of commerce, removal of burdens on mergers and acquisitions. Uh, and that did certainly lead to a relatively short-lived spike. Since then, the news flows have erred on the cautious side, and there's a bit more human disillusion creeping in. We've kind of been skeptical of that Trump plus tech story pretty much from the beginning. You'll see that in our quarterly outlooks. So we didn't ride that, and you'll see later our positioning is actually quite consistent with what we're seeing now. It could be that this sentiment indicator is now stretched to the downside, and you could see some stabilization, but it's very early to call that the downside is stabilized. We've had about 8.5% drawdown in the S&P from its record level in February 19th. But there's still a lot washing through in terms of some leveraged positions, people who had jumped on a bandwagon looking how to jump off without losing too much of their capital. So watch the space. Still very choppy waters. And if we do get into lower growth, as you see on the next slide, that won't necessarily mean immediate rate cuts. The expectation of inflation looking forward in the Mitch survey, which is pretty influential with the Fed, has risen. And that's obviously because people are conscious of tariffs. A lot of the public see inflation as prices not going down, i.e., not disinflation. No economist or strategist would actually expect disinflation, but the public seems to have an expectation that a new regime might bring a reduction, not only in the rate of growth in prices, but actually in prices themselves. That's very, very likely to be disappointed. Meantime, the unemployment rate at 4.1% in the US, very low. So those people in work will be seeking to preserve purchasing power with wage increases where possible. They're buttressed in that quest by the restrictions on immigration. Immigration is very important in allowing disinflationary processes to take place. And the current administration seems to be wanting to block that. So, what do we believe is a general future for funds like ours that aim to achieve capital growth over the medium to long term? Well, we've observed some waves, and you can see that on the right-hand side. If you go back to either a fully equity portfolio, the red line in that upper chart and the lower chart, versus a fully bond portfolio, which is the yellow line at the bottom. You can see that over the last 35 years, the advantages in adding more and more global equities have been clear. They've rallied the hardest, and the periods of bear market drawdown have got progressively shorter. That means, that you have had very, very strong, actually atypically strong, if you look at history, returns from global equities, and the S&P and US equities being the greater part of that story. These three bear episodes that we've seen have been of diminishing length. So if you look at statistically, that's not a major downside risk to be afraid of in structuring your strategic asset allocation because the bears don't last very long. And it pushes you ever more towards just gradually, incrementally lifting equity allocation. It doesn't have to be a threat to medium-term capital preservation, except that there's a huge concentration now in tech and in the USA. If I look at the index benchmarks, they are much more vulnerable to disappointment. You have 31% of MSCI US in IT, 25% of MSCI World is IT. If you add financials in, it's 45% of the USA and 42% of the world. So you're quite reliant on those sectors continuing to generate strong profit growth, while the traditionally defensive sectors, staples, healthcare, utilities, have been really pushed down in their weights. Together, they make up just 20% of the MSCI World Index. So we sort of saw this coming and thought that this was potentially a risk, and we built in the middle part of 2021, when I joined SALT, a new type of capital accumulation growth fund. Features of it are that we still want an 80-20 growth income asset allocation. That's necessary to achieve the expected returns that a growth investor wants. However, it's not just bumping up, in our view, that international equity component and saying, well, we're going to have more volatility, but that's the price of growth. Yes, it is, but there are other alternatives. There are other types of equities. Not all are alike. So we leveraged some good relationships with listed real asset managers from our traditional, areas of global listed real estate and global listed infrastructure, and we determined to make that a meaningful part of our growth fund. We set each of those at a 10% strategic weighting. That's pretty punchy by the standards in the market, and of course, at times that leads to divergence in peer relative returns, but we're confident that there's some very good quality assets in those pools. Okay, and then we look at capital market assumptions all the time. We're convinced that the expected return over the next decade from global listed real estate and global listed infrastructure is plausibly higher than that of global equities. And part of that is because of the sheer dominance and valuation levels prevailing in the US market. So you can see the pie on the left-hand side just illustrates what I was mentioning, that real estate utilities, which is part of infrastructure, has been pushed down to below 3% of the global index by sector weighting as IT grew, as as the communication services sector grew to larger parts with those very, very high PE multiples, multiple expansion for the banner flagship companies operating in those areas. The right there, you see what we did. We said, okay, we still want a good dollop of international equities, but unlike, say, the average or median New Zealand manager with 50%, we would go 35% benchmark to MSCI World and the additional 20% to the listed real asset sectors. So both us and the peer group have about 55% in global equities, but ours is allocated somewhat more into real assets, and we dynamically tilt between the pure market play of global equity and the specialized marketplace in listed real assets. We don't think that we are doing too much, of risk in that sense, in that we are actually structurally less vulnerable to the bubble sectors. We don't think that there's any bubbly pricing in listed real assets. There has been historically, decades ago, but we're not presently in that situation. And that contrasts with the sectors in which you could argue that there was bubble valuation. So if you go to the 95% of the MSCI World Index that isn't listed real assets, you can see a rising market cap over time, which has led to the fund clustering, other funds clustering into winning trades. And I think people are febrile, to use a medical term. They're in a sort of fever state about whether this is actually great and that's the future with AI and so forth, or whether they may have got a little over enthusiastic of that theme. It's a personal choice, but we think we have less sub-industry concentration. It's a broad church now, what is in listed real assets. There's an enormous number of sub-asset types, and they have better characteristics over time to diversify. Economics-wise, the US was quite exceptional. It still is to an extent, although it's starting to slow now. And you see that in the confidence measures and the PMI measures that have come through. sinking back down since that euphoric moment after Trump's election to barely positive. Europe has meanwhile come back up to basically a neutral level. So we think that US growth is going to be revised down this year. Morgan Stanley Investment Management have taken the 2025 forecast down to 1.5%. That's pretty low. They had been at 1.9 and 1.2 next year. Others will no doubt follow. And with that will come downgrades to earnings expectations too in the corporate sector. Trump's policies are really the wild card here, you know. I mean, just as much as the policies can really put fear into markets, they can also put petrol on the fire of enthusiasm if the right things get announced. So I just say, watch this SpaceX. There's a little bit of irony in there. We don't know, to put it bluntly, how the administration, with its apparent attitude that it's free to do what it wishes, will respond to weakness in asset markets. They may attempt to cauterize that by some measure that no one is yet expecting. But broadly, you can say across that survey from the Purchasing Managers Institute that companies are reporting a lot of disruption, concerns about impact of policy, political landscape changes, manufacturing issues, confidence issues, and the Fed won't be able to respond to lower growth fears because the higher prices percolating through the system are restraining their hand. So it's not yet quite a perfect storm, but you could say you might be on the edge of what could become a perfect storm, unless sentiment changes within the next month or so. The inflation picture is interesting because even that is politicized now. When we looked at that inflation forecast survey, you can see Democrats think inflation is going to roar up well above 4%. Republicans think it's going to go to zero, and that the Trump magic will somehow allow this pricing trend to offset all that evil Biden inflation. Although it's kind of a bit unfair to blame Biden with it, because as you can see on the right-hand side, the inflation was rising under the last year of Trump, and it got baked in by COVID. Most of the Trump policies did have inflation effects, but they were just lagged inflation effects. And of course, when COVID came along, it just supercharged those inflation effects. Plus the federal spending, which Biden went on a spree, there's no doubt about that. But the story that Trump back means low inflation back is a heroic assumption. So, just to look at what happens in the third year of a bull market. Traditionally, it's the weakest year of the bull. We've had two 20% plus gains in US equities, and we're now entering year three. Historical average for that is about a 5% gain. We might see that. We might see something in the upper single digits by the time of year end, but there are more risks than there were previously, and we've gone a little bit more defensive on that basis. So we think valuations are better in real assets and in some quality sectors of equities. So you don't need to go complete risk off. You can rotate, and that's what we've been doing. You can see this in the growth fund. So this is very recent. We were quite underweight NZ equities. We had been since the fund started. We've moved up slightly closer to a neutral weighting. We're actually now only 2% underweight NZ equities. Not thinking that the NZ corporate sector is going to boom immediately, but a lot of bad news has been priced in. We also lowered an allocation that we had an overweight allocation in infrastructure because that has played out very, very well. We have a small underweight in global equities and a small overweight in global bonds at the moment. That's looking through the next 3 months. We don't think there'll be a rapid rebound in US equities, other things being equal, but Germany, which is an overweight within the portfolio, is doing quite well. And that's partly the result of this fiscal liberation that the new chancellor has allowed in response to Russia's aggression. We think that the beta of the global equity market is risky just because of that very high weighting of the US in the index. So we're quite happy to go a bit off benchmark in that regard. We only have that small overweight to global bonds because of those inflation pressures still being around. And we have higher expected returns from non-sovereign credit, but you have to be very active, very selective. and watch the ratings outlooks closely because ratings will change as the economy slow. Finally, just performance. This kind of more cautious tilt has worked okay for the fund. We've picked up alpha in the last 3 months versus the SAA weighted construction, the reference portfolio. Over the 6 months, though, that's both the period of correction and the period of euphoria prior to that. So pretty much in line with that SAA index there. Over longer periods, we're picking up, around 1% alpha on the 2 year. If you go right back to inception, we're fighting with this 2022 bear market in both equities and bonds, which was the first full year of operation of the fund. But that doesn't affect our long-term modeling. We actually think that that's quite credible, 6% annualized over that period. We're quite comfortable that we won't have any trouble reaching the 8.5% average annual return. Thank you very much, and I'll just check if there are any questions.
Great, thank you for that, Greg. That was a fantastic presentation. And yes, a couple of good questions have come through, so I'll let you answer those now. The first one is, how do you decide your percentage allocation to Australian and New Zealand equities?
That's a good question, actually. The portfolio managers in Salt are specialists in both. Traditionally, they've been more New Zealand equity focused, and we have both a core New Zealand fund and a dividend appreciation fund, and we also have an enhanced property fund. So those latter two are more likely to go Australian. In terms of what we have in the growth fund, it's going to be a New Zealand play. So if we get Australian exposure in there, that will be coming in through the global equities or the global listed real assets funds.
Fantastic. And so that probably answers the next question, which was, can you talk about how you access your listed real assets and do you use any external fund managers? Do you want to
Yeah,
elaborate or?
yeah, sure. I will quickly. We launched a couple of NZ pies, global listed infrastructure and global listed real estate. The investment partner there is Cohen and Steers, New York, very well established, esteemed real estate specialist manager. But from a New Zealand investor's point of view, you just come into our pie and you're treated as if it were any other managed fund pie.
Fantastic, thank you. And final question we've got from the floor, and just a reminder to all attendees that you're welcome to put any questions either for Greg or our next speaker, Alan, into the question and answer feature of the webinar. But the final question for you, Greg, at the moment is, have you done any work on how the Department of Government Efficiency, slashing of government's departments, will affect the unemployment rate in the US?
It's really interesting. I mean, in our quarterly outlook, which we published in early January, we said, watch out for unintended consequences. It's a eternal law of economics. It may look like that these are just efficiency cuts, but they have multiplier effects. So we don't think the US federal workforce is of itself going to push the unemployment rate up sharply, but those Fed workers pay other people in the private sector down the chain. And there could be a snowball effect. And I don't think the administration is taking account of this at all.
Fantastic. Thank you, Greg. And that's right on time. So I will now pass over to Alan. And Greg, you're welcome to stay on the line or move on to your next commitment. Okay, everybody. Now up next we have Alan Clarke from Nikko Asset Management presenting. Now, Alan is the portfolio manager of the diversified funds and the external investment managers at Nikko Asset Management. Now, with over 20 years of experience, Alan had 16 of those years at ANZ Investments and held investment roles at Theta Capital in Amsterdam and Morley Asset Management in London. Now, Alan joined Nikko in 2023 and brings extensive expertise in portfolio management and investment strategy to our business. Now, I'm excited to hear today from Alan about the Nikko Asset Management Growth Fund, which is available on GoalsGetter. So I will pass over to Alan to share his slides and take the floor from there. Over to you, Alan.
Thank you, George. First thing is to check, can you hear me all right?
We can hear you, yes.
Okay, that's going so far, so good. Second question, can you see a presentation?
we can. So we're
Wow.
all sorted. Over to you.
Hey, I'm ahead of my expectations already. Hello, everyone. Thanks for your time today. Nice to be here. I haven't had lunch yet, so if anyone is eating, I hope you enjoy it. Uh, as as uh, as George said, I've joined Nikko 18 months ago in this role, looking after the diversified funds here. And today I'll focus on our growth fund. But as you'll hear from me, there's actually quite a lot of consistency, whether I'm talking about our growth fund or our balanced fund or our conservative fund. And I'm also responsible for the external managers, where we partner up with what we think are some of the best global fund managers for those global asset classes. And as George said, I have done a similar role for a number of years at ANZ Investments and the predecessors, One Path Funds Management and ING New Zealand. So a lot of my sort of experience in the investment management industry has been looking at diversified funds and external managers. Before I get onto our growth fund, what I wanted to do was just give a little bit of background into Nikko New Zealand. Some of you might be familiar with us, and if you're not, I'll try and just give a bit of colour of who we are and what we do, and that sort of hopefully will lead through to our diversified funds. And yeah, what I'm going to do today, especially for the growth fund where it's sort of most pertinent, I will, as an example of one of our key approaches, I'll spend a bit of time on our approach for global equities, which, as you can imagine, is the largest allocation for those growth funds. So who's Nikko New Zealand? And we are a fund management firm managing. It's actually just over $9 billion now as of the middle of the first quarter of this year. So been in New Zealand since the early 90s in one form or the other. Initially, sort of part of some of the insurance companies that were located in New Zealand from offshore, and since about 2011, a member of the Nikko group. If you think about the clients we have, of that 9 billion, about 80 to 85% is what we call institutional clients. So that'll be, as we say there, the community trusts. We have some iwi groups, old-fashioned or sort of company pension plans or superannuation plans. Charitable council portfolios where they've got some effectively endowments for a particular region of this country. And so that is effectively what you might think of as our bread and butter. So across those many clients, some of them come to Nikko New Zealand for one asset class, two asset classes, and some of them come to us for a diversified portfolio. And we like to think that depending on those different client needs, that we can help them out. We can help them manage their portfolios for their own whatever their needs may be in terms of time frame and expectations on return. Staff here is just over 30 people in Auckland, up to 33 since printing this slide, and 10 investment professionals, and then equally importantly, a very well-resourced and experienced team in operations and legal and compliance and governance, and that and what we'd like to think of as a full service funds management business. And just in terms of the Nikko Asset Management Group, if you're not familiar with that is as a Japan headquartered entity, fully owned by a different Japanese trust bank by the name of Sumitomo Mitsui. But Nikko Asset Management is a reasonably large asset manager in its own right, nearly $250 billion under management around the world. Probably not surprisingly, a lot of that is still in the Japan and Asia region. But since that, the acquisition here in New Zealand in 2011 was part of a strategy that is still ongoing to grow those assets under management organically and inorganically around the world. And so there is now Nikko businesses in Europe and the UK and the Americas, and there's still this ambition to be larger outside of their home country. In terms of how Nikko New Zealand benefits most from this global parent, I'd suggest a couple of good examples would be in the sort of operations and compliance world. We do have colleagues in compliance around the world doing the very important sort of investment governance and compliance work. So our team here have the benefits of very experienced practitioners around the world to sort of share ideas to make sure we're keeping up with best practice. So there's lots of examples where we have effectively dotted lines up to other colleagues in the many various parts of investment management where we're getting to sort of share ideas and make sure that we are still staying up to date with all the requirements of a top drawer fund manager. And just a little plug for later in the year, if you don't like our orange and blue branding, we are going to be changing our name from Nikko to Amova. So from about 1 September, you'll see less of the Nikko orange and you'll start to see more of the pink and purple brand that will be Amova Asset Management. So again, that's a global change where the Nikko brand is going to be replaced with Amova Asset Management. So look forward to that when they come out in the next few months. So Nikko New Zealand, what do we do and how do we do it? So we're an active manager, and that's across all the asset classes. We don't offer any sort of passive or index tracking solutions. And we believe that we can, following a disciplined, well thought out investment approach, we can help our clients grow their portfolios and sort of optimize their risk adjusted returns compared to a sort of broad passive or buy everything approach. The specialized piece there refers to within each asset class, we want to have sector specialists. So as you'll hear from later in the presentation, we have an in-house folk who look after Australasian equities and listed property. We have a separate team doing Australasian bonds and cash. But for those global asset classes, while sort of theoretically and operationally we could manage global portfolios from Auckland or Wellington or New Zealand, somewhere in New Zealand, we think we can get a better outcome for our clients by partnering up with some of what we think are some of the best global managers in the world. They've got the folks around the world meeting those company management, meeting their companies, and really understanding those businesses better by being closer to where they operate. So our approach is for that specialized approach within each asset class. And then in terms of those, again, regardless of whether you're talking to our in-house teams or the managers we appoint, we've got a preference for that sort of holy trinity of quality, liquidity, and simplicity. So all our SQL, we're going to stick for what we would call quality assets within each asset class. An example there would be both for the Australasian bond portfolios and globally, we don't invest in junk bonds or high yield bonds. We want the bonds to do a specific role for our clients' portfolios, and that is to be of the highest quality and not have those sort of credit concerns that come with going a long way down the quality spectrum. And the liquidity piece, of course, is often linked to quality. And again, we're conscious that it's our clients' money, and what we don't want to have is any of it tied up or locked away because of an unforeseen outcome with trying to take advantage of some illiquidity premium. And as you'll hear from me, what we have the ability of sort of choosing who we partner up with. So when you hear me talking about our approach to global asset classes, the managers that we partner up with, it should be no surprise that for many of these sort of core beliefs, they share our investment philosophy, and that's why we think it's a sensible, consistent approach, regardless of whether the monies have been managed in-house or externally. This is just to be clear, this is past performance, and I'm well aware that past performance has no, and it should not be taken as an indication of future performance. But I did want to show this is our track record across some of our sort of core funds over a number of years. Now, full disclosure, these are the wholesale funds. These are effectively zero fee funds, and these returns are gross before any fees are taken out. And this is a combination of strategies managed in-house, the top three by our in-house cash and bond team. Global asset classes have always been managed globally, and the core equity, the concentrated equity, and the property fund are managed internally as well. And sort of, I wanted to show this because when I was appointed here 18 months ago, Stu Williams, who's the managing director here, he asked me to sort of have a look at the Nikko approach to diversified funds and sort of without fear or favor, give my thoughts on them and if necessary, make some changes. And my most obvious thought was that we have very impressive approaches within each asset class that is required to be the building blocks for a diversified fund. And so, there were some other sort of more esoteric, unorthodox parts of the Nikko diversified funds that were put in place maybe sort of 5-6 years ago. And some of those didn't work out very well for our clients over that incredibly volatile COVID and post-COVID environment. And so my main observation was, we've got a number of these institutional clients who are very, very happy with the overall returns, either from one or two or more of these these different funds. And what what a diversified fund needs to do is to showcase or to bear the fruits from the underlying approaches to the different asset classes. So the diversified funds at Nikko are really going to reflect these underlying approaches. And as I said, within each asset class, it's a specialized approach. It's a team of experts, either in-house or externally. And what we're trying to do is let the active returns within each asset class, generate the added value for our diversified funds as a whole. We made these changes sort of Q3 last year, sort of removed a couple of the esoteric investments. One example would be an allocation to the ARC fund. The ARC fund is still available for clients who would like an allocation to that very long sort of time frame, technology focused approach to investing. But that we want it there as an option for those who want it, as opposed to sort of having it in all of our diversified funds. So that's just an example of moving back to a more orthodox approach for diversified fund clients. So as I said, that's a little bit of the background of when I joined 18 months ago. The brief I was given was to make tweaks or enhancements, hopefully, to the approach. And now going forward, we think we've got a really disciplined approach within each component or asset class or building block of the fund. The long-term approach to investing it is reflected within each fund, if you like, whether you're talking to our investment team in-house or some of the external managers. We don't sort of partner up with external managers who do something in a sort of different way to the way we think about investing. And then, what we've got is, you can think of it as a couple of internal teams and at least 5 external teams. So we've got a very diversified bunch of added value opportunities within each asset class. And again, that the diversified funds will just reflect that a combination of those different sources of added value. No single team or approach is going to make or break the success of our diversified funds. We think it's really worked. So they're diversified by equities across the asset classes, diversified across the regions. That's reasonably straightforward. But even in terms of where we're going to add value going forward, we think we've diversified that across a bunch of uncorrelated teams. We will be moving the allocations through the cycle as well. That was another thing that previously hadn't been done. The approach I described before I got here was a bit more of an old-fashioned strategic asset allocation approach, where, rigorously and routinely, the SAA was reviewed annually, which is a good discipline. But of course, the problem with that approach is if you have a dislocation or a change in the market, it doesn't always line up with when you wanted to sort of have a look at your settings, if you like. So the ability for us to think about where we are in the market cycle, make some adjustments. If we think there has been a decent correction in the markets and that going forward returns from the risk assets of equities should be higher going forward, we would lean into that and overweight them. And if we think that there is a recession imminent, a good chance of a decent equity market correction, we can look to take some risk off the table as we assess where we are in the cycle. The 3 funds here just by asset class are shown. So again, I'd suggest there's nothing too different to a lot of the other funds you'd see out there. The conservative fund, 23% in those growth assets. For us, the growth assets are equities and listed property, defensive assets of bonds and cash. Balanced fund, a 62-38 combination, and the growth fund, 80-20. And as I said, I'll focus a bit more on the growth fund. But when you think about the approach, when you think about the building blocks for these 3 funds are all the same. One area we're looking at is whether we should launch an aggressive fund, or a high growth fund, I should say. That's a fund with sort of less of the cash and bonds, and that would be thinking about some of those younger KiwiSaver members, for example. If a KiwiSaver member does have 35, 40 years until they are able to access their clients, a very good question they might ask is, why would I bother having any cash and bonds? And so we are considering an allocation to it, or creating a high growth fund, and it should be no surprise that if we did that, it would also use the same building blocks of the different approaches we have for each part of that global opportunity set. Just a little bit on the teams, if you're not familiar with our team. the cash and bonds team here, very stable, experienced team. This slide is also a touch out of date. We have a new gentleman by the name of Pranav joined just in the last 3 months. So that's now a 4-person team looking after the local cash and bond portfolios. And again, hopefully no surprise when you think about what their approach is. Again, orthodox active funds management. So in bonds, a big part of that is, as Fergus has said for years, the first question is where are interest rates going? Second question is when, and just a consistent way to sort of assess the local economy here, the likelihood the government or the central bank is going to be making movements and trying to either increase or decrease fiscal and monetary settings. That's the sort of what these guys sort of eat and breathe in every day, and they've had a very strong track record of consistently adding value over many different cycles in that local cash and bond universe. But again, it's a high quality sort of long investment time frame approach when they're not sitting here actively trading around short-term trends or anything like that. Similar for the in-house equity team, a team of 5 there. Michael Sherrick's leading that team. And these folk will manage the 3 of the funds within the diversified funds. The core equity fund, think of that as a New Zealand Plus approach to Australasian equities, whereas the concentrated fund is a bit more trans-Tasman, less names, and we combine those 2 funds to get quite a good sort of trans-Tasman mix of, again, an aggregate looking for the sort of 30 or so, 25 to 30 best companies in Australasia. And the property fund is a nice complement there for all the diversified funds. Again, in particular, the growth fund has a large allocation to equities. So we do believe that an allocation to that more stable and sort of uncorrelated return stream you get from property, that effectively being a landlord is a different sort of return stream of earnings and a more stable one. And that gives a nice sort of diversification benefit for the diversified funds. And that's also an Australasian fund. And again, you'll hear me say it a lot, an orthodox fundamental approach to active management, looking to really understand the businesses, meet with management, work out which companies we want to own in the long run, and when there are mispricings to take advantage of that. The external manager piece, as I said at the start, it sort of falls under my remit. And yeah, as you've heard me say, when we think about an external manager, either one that we have currently partnered up with or one that we're considering partnering up with, we can sort of get from a very large field of potential global managers to a reasonably small and manageable one by just focusing on managers who share our beliefs. So we haven't looked to find short-term traders or sort of noise merchants or some of those, or teams that are built around the success of one person, like the old star portfolio manager approach. Those things can be like shooting stars. They can do well for a short period of time, but then sometimes once a person leaves or if something goes against them, there is sort of nothing behind their approach. So we're looking for consistent investment processes implemented by a stable and experienced team through a number of market cycles. The integration of responsible investing, of course, is important, and it is interesting when we look around the world. Many global managers have done a very good job in enhancing their investment processes as the expectations from clients in New Zealand and around the world have increased with regard to responsible investing. So we do assess to what extent, whereabouts on the spectrum does this manager sit? Have they moved forward with this very important sort of groundswell into integrating responsible investing considerations into their process. And then with the people in the business, no kidding, we want to get to know the people well, not just the investment team, but the business leaders as well. We want these to be well-run businesses with experienced people, stable firms that are successful in their own right. And the performance is, of course, very important. That's what comes out of this whole exercise. And we are continually reviewing that. We meet with the managers and discuss it. And that's the sort of what we talk about is the key criteria with our underlying managers, and that's what we're sort of continually assessing. The managers that we have in our lineup, I'll start with the Global Bond Fund. This is a reasonably small allocation for the global for the Nikko Growth Fund, of course, because only around 10% of that fund is in global bonds. But of course, this is more important for the conservative and balanced fund. But Goldman Sachs has been the manager for our global fund here since 2012. So that's an investment team of, think about over 200 analysts and portfolio managers, make it 220. A lot of them are based in London, but as a large global firm, Goldman Sachs Asset Management will have about 220 people, London, the Americas, Asia, Pacific, either specialists, economists, strategists in their own region, and right across all the different opportunity sets within global bonds. So again, that's something that while we could create something similar, try and create or manage a global bond portfolio from here, we think having over 200 investors and portfolio managers and analysts sort of working on behalf of our clients on that very large opportunity set is a much more sort of efficient and a much more a much better approach. And we're very happy with Goldman Sachs. They've done a good job over a number of years through the different market cycles. And as I said at the top of the call, we get to sort of set dictate the settings for our own mandate. So, for example, because we don't think our clients sort of want or need to have some of the low quality bond paper in the portfolio, we can set things like that. So this is an investment grade only portfolio, benchmarked to the global ag index, and just we're tasking Goldman Sachs through a combination of interest rates, directional curve settings, good security selection within credit and asset and mortgage-backed securities to build a portfolio for through the cycle. The global equity approach, that is a multi-manager approach. So because of the more interesting and diverse opportunity set within global equities. So think about 5 to 10,000 companies that we can choose from. Something like the ACWI benchmark will make it 2,700 names. We don't want to try and own over 2,000 companies. We think an active management approach in such a wide opportunity set is possible and to add value consistently through the cycle. And we've chosen 4 managers and given them slightly different tasks to achieve that. The top 2 managers there, Royal London and JP Morgan, are what we call our core or style neutral managers. So they're going to build a portfolio of sort of 40 to 70 names, a blend of sort of characteristics. When you look at their companies, you're going to see a blend of undervalued companies, sort of old-fashioned Warren Buffett investing, if you like, also offset by some of the more exciting growth companies out there in the world, and a bit in the middle, a bit more of those core names. So they're the sort of ballast of the overall portfolio, and then a 20% allocation to Nikko Europe and to WCM. So they're our growth managers. They are tasked with sort of investing in that. What are the most exciting parts of the investable universe? That's companies that are in an exciting industry, new product launches, the ones that have got some of that much more future dated growth on their horizon. No kidding, you're sort of paying up for, in terms of price to earnings, you're paying a bit more for a good growth business if you own the shares, but a good growth manager can, that's their job, is to work out which company is going to be successful, what's a fair valuation for that future success. And they bring a bit of that growth, a bit of that to the overall portfolio, so it has a slight growth tilt, but we think we've got so no matter what the macro world throws at us, we think there's a good balance of names there. So we visit with these managers, we get to know them pretty well. There's a little bit of background here on those 4 managers. I did a trip last October, going around the world, visiting with these folk on their home turf and sort of meeting more of the people. We are quite lucky that a lot of them come down to Australasia to meet with us, but it is certainly good to sort of meet with them on their own turf. And on those trips, we also do spend probably twice as much time visiting other managers. We've got a sort of reserve bench, if you like. If there is any reason to change from one of our incumbent managers, we've got a reserve bench that we know well enough that we sort of like and rate highly, if we do need to consider to change. And just to finish, again, because this is over 50% around about 50% of the growth fund, is the global equity fund. Just to give a bit more colour to it, here's the top 20 names of the portfolio. This is actually showing that this is the companies that overlap. So as I said, these managers are tasked with slightly different roles within the portfolio. So what this is showing is that I think it's 19 companies that are held by more than one manager. So the overall portfolio, combining 4 different strategies, is about 160 names. So again, there's no magic number there. We don't think it's very sensible to try and buy 2,700 names blindly, but nor do we want to have too much company-specific risk versus that benchmark. So we think we've got a pragmatic and prudent approach to combining 4 different strategies. And sort of no surprise where they do hold the same name, it is in some of those mega caps that have done very well. They are of course very large parts of the benchmark now, but as you go down that list, they're also getting exposure for our clients to some of these much smaller and really interesting businesses around the world in a whole bunch of different industries. So while we consider these 4 managers in aggregate have done very well in the last 5 years as those mega caps have dominated. But as we saw already in the last 6 months, when some of those mega caps have come off their lofty valuations and had a bit of a correction, there's a lot of other holdings in the portfolio that have done very well as well. So we think this is getting our clients really good exposure to that opportunity set, the mega caps, the large caps, the mid caps, right around the world. And that's what gives us the confidence going forward that these managers in aggregate are going to deliver good returns for our clients. I've gone 26 minutes, and that was what I'd prepared. So again, just to finish, we think these diversified funds, they do reflect our sort of headline approach for each asset class. I've tried to reflect that we do have a number of institutional clients. The average institutional clients for Nikko New Zealand has been with us for over 10 years. So we've got a lot of clients that are very comfortable with our approach to investment management, and sitting in front of those institutional clients, the investment team will typically meet with a lot of those clients quarterly. So when institutional clients are quite rightly demanding of our time, and we meet with them and tell them what we're doing with their portfolio. If we change an approach, if we add persons to the team, we're telling them and their investment consultants what we're doing and why. And I think that brings a real rigor and a discipline to everything we do, managing our clients' money. And what we're trying to do here with our approach to the Nikko diversified funds is to bring that institutional grade investment management to the sort of KiwiSaver and retail world via our diversifieds. And we think with the GoalsGetter, with the multi-manager, we think it is a really good complement to some of the other approaches that we have out there in New Zealand. And I'll finish there because I've just seen George pop up.
Fantastic. Thank you, Alan. That was a great presentation. A reminder to all attendees, if you've got any questions you want answered by Alan, please put them in the question and answer function now. And Alan, I'll start you off on your first question that's come through. So just to clarify, is there any ARC still in the Diversified Growth Fund?
No, there is not. That was removed, and that change we made Q3 last year. There was also an allocation to a fund of hedge fund strategy ran by JP Morgan Alternative Asset Management. That was also removed. That strategy had been sort of built and was born out of that low interest rate environment that sort of pervaded for most of the decade after the GFC. So yeah, that was 2 of the main changes were to take out the fund of hedge fund strategy because we don't believe we're in a zero interest rate environment anymore, and to take out ARC. Albeit that ARC is still available, as I said, for wholesale or retail or KiwiSaver clients, if they would like to make that allocation to their own portfolio.
Good, thank you. And you talked a little bit about being able to move funds around tactically, either leaning in or taking on more risk or de-risking. With the recent run in markets and the more recent talk of a recession in the US, are you considering moving anything else tactically in the near future?
Yeah, good question. I mean, we're always considering it. The short answer to that is no. I'm still characterising this as a period where we're going to have a lot of volatility. And yes, the tariff war has the chance to sort of shave a little bit off growth expectations. But in terms of effectively a full-blown recession being likely, and that could be led by just one country like the US, which would often pervade around the world. That's still not our base case. So we're not trying to move these portfolios around on a sort of week-to-week basis. We're trying to think a bit more about that 6 to 18-month view. So the fundamentals of sort of economic growth, interest rate settings, inflation headaches, we're still, the trade wars do pose some risk to some of those. But at this stage, when we get these periods of volatility, what we look to do is sort of after we've had a rally, we'll trim some of the equity holdings on the strength, and then after we get these short-term sell-offs, we'd look to keep them. So we're basically keeping them around the target, the long-run setting. But we're trying to we wouldn't sort of go underweight unless we thought a recession was imminent. And likewise, to increase risk, we haven't increased risk over the last 18 months because it has been a strong run. We are sort of conscious of the, I don't think euphoria has been built into the markets over the last 18 months because it was such a sort of choppy, uncertain recovery. We were effectively, a lot of investors were waiting for this US recession that never came. So it was the sort of classic climbing of the wall of worry, a classic grind higher over 2024. But that's not a period where we'd look to go overweight. We'd typically look to go overweight after we get the next sort of meaningful correction, a meaningful dislocation where, that we've seen, we will see again at some point of sort of, over 20% correction in equities is when you start to look at thinking about going overweight.
Great. All right. Thank you, Alan. Well, that's time, everyone. So just a big thank you to Greg and Alan for two very informative presentations today. Hopefully, advisors, you will have seen some value in those to help you with your client conversations moving forward. Also, thank you to everyone for attending this afternoon. It's great to see so much continued support for these GoalsGetter events that we're running for you. And a quick reminder that this was part 2 of a 3-part series. So if you missed part 1, which was last month in February, that was Pathfinder and Harbour Asset Management speaking. So a recording was sent out last week in the Advisor GoalsGetter newsletter. If you can't find that and need a copy, just let me or Katie know and we can resend that to you. And then the final and part 3 of this Lunch with GoalsGetter webinar series is next month on Tuesday, the 8th of April. So the speakers for that webinar are going to be Jonathan Windust from Milford and Daniel Frost from Generate. So we look forward to you joining us then. And if you're already registered, then you'll automatically receive the link to join. And if not, please pass on the details for registering. And we look forward to seeing you all then. Have a good rest of your week.